This podcast is intended for investment professionals only.
Towards the end of her life, the celebrated writer and civil rights activist Maya Angelou was asked whether she's a nostalgic person. She replied, "I have great respect for the past. If you don't know where you've come from, you don't know where you're going. I have respect for the past, but I'm a person of the moment. I'm here, and I do my best to be completely centered at the place I'm at, and then go forward to the next place." I wonder if Maya Angelou's sentiment might be applicable to the world of ESG, which is characterized by targets and a relentless focus on the future. How can we know where we're going without knowing where we've come from? I'm Harry, a content manager at LGIM, and today I'm joined by our head of index solutions, Fadi Zaher. In collaboration with our investment stewardship team, his team is about to publish a landmark research paper titled Insights from 14 Years of ESG Data, which you'll be able to find by searching for LGIM Insights. Fadi, thank you for joining me today. I wonder if you can start by just giving us a bit of background about the aims behind this research paper and a bit of colour on the data that informed it.
Thank you, Harry. One of the key purpose of the research was mostly to understand the trends in global financial markets across different regions, across different sectors, across different themes. And so we have been collecting the data, and we were able to go back nearly 15 years, almost 1.5 decades, so just short of that. And that effectively tells us how environmental stories has evolved. It tells us how social stories when it comes to ESG, governance stories, and also how transparent companies have become over the years. And these are very much engagement themes that LGIM stewardship effectively pursue. And that goes back. We started this work about 5 years ago, just over 5 years ago, where we created an LGIM designed ESG scores, which focused on engagement topics rather than taking just broad indicators across E, S, and the G and creating a rating of that. We went down the route of focusing on the themes, about high level 18 engagement themes. And within the themes, there are about 34 indicators. We focused on that. And that's really where the study is actually focused on, is this 34, which started with 28, by going back in time and see how this has evolved.
That makes sense, Fadi. I'm sure, like everyone else, I receive dozens of ESG papers of different stripes every single week. What sets this apart? What's different about this research and this research paper?
Yeah, so I mean, when we discussed this for the first time now, over 5 years ago, with our stewardship colleagues at LGIM, who's doing a phenomenal job when it comes to engage with investee companies, setting goals, actually very transparent also with the investee companies. These ESG scores, for example, they're available on our external website, where you can see every company can see their own ESG ratings and also how they're doing on the different themes and the different topics. And this is a more focused, targeted approach, and it's a structured engagement program that our colleagues in stewardship team are pursuing. And so, unlike other approaches, for example, that are out there in the market, they tend to for example, contain for sure more than, say, 34 indicators as we currently have in our ESG framework. But that could be as much as 200, 300 indicators, and it's kind of averaging across these different metrics. That's kind of the general market-based approach for ESG rating framework versus the engagement-based framework that links to capital allocations.
Okay, that's useful, Fadi. Thank you. Having covered that background, I wonder if we can turn now to the biggest headline finding, and the question I'd put to you is: have ESG scores risen at a global aggregate level over this almost decade and a half that you've been looking at?
This is a very positive story, and that's what makes this findings so interesting, because we were able to see an increase across different ESG pillars across the whole history. So from February 2009, when the data started, we have seen, for example, the E score across the global markets increased by nearly 50%. And when you looked at the S, we've started to see also in the region of 80% increase over the nearly 1.5 decade of history, and similarly for transparency. which shows us a huge interest and developments within the environmental on the environmental side, but also within the social and transparency. But interestingly, we saw less improvement on the governance, but that's because generally listed companies and the companies represented in the global benchmarks are typically well-governed companies.
As you say, a really significant improvement almost across the board then. I wonder if I can follow up by asking whether there are particular regions or countries that stood out to you in terms of the level of improvement they've been able to make over that 14 years.
Obviously, when you look at the size, like the different markets, which ones? So the US represent nearly 65% of the global equity benchmark, and that's an important one to see how that has evolved. And interestingly, because it's the biggest one, and we were actually also able to see that there are some actually through the data some cultural shifts, which shows that actually US listed companies are moving toward more sustainable practices. That's just come through in the data. This is not just an assumptions. And when you look at just the overall ESG trend within North America, it has nearly increased by 50% over the 1.5 decade. And that within that, when you look at the increases in within the environmental, social, and governance, the different themes, is looking at the emissions. This definitely means, for example, from an emissions perspective, the emissions has definitely been going down in these benchmarks, not just in one specific sector. Actually, it's across the various different sectors. Another country that probably started when we looked at the data from a lower base, but had the biggest improvements and was the biggest surprise for us, was that Japan. Japan has effectively doubled its ESG scores over that history of nearly 1.5 decade. And that's, we've seen changes happening within the themes. If you take, for example, the social diversity, women on board back in 2009 was nearly 1% in the benchmark. And now, nearly 15 years later, it's standing on around 14%, so nearly 15% rounded up. So that's a dramatic shift in the benchmark. And that's also been seen in Japan for other areas as well. When it comes to transparency, Japanese companies have become more and more transparent. Interestingly, in emerging markets, that trajectory is also in a positive rise. But we saw also different dynamics in these different regions, where emerging market was not doing very well until post the pandemic. And post pandemic, we started to see a rise in disclosure around data from the emerging market companies. And we also started to see improvements on the underlying metrics as well.
It is a fascinating story. Having read an early draft of the research paper, you really get a sense of these overlapping narratives, which are different in different countries, and as well that we've seen different types of improvement across different sectors. I wonder if you can perhaps pull out one or two sectors which have made particularly notable improvements in their ESG scores, and what the reasons for those improvements were.
Yeah, and that's a good question, Ari. I think one important element to keep in mind is that every region, we're coming into the sectors, but they're all linked in. So every region has a starting point when it comes to compositions. So if you take, for example, the UK, the biggest representation in the UK benchmark is financials, followed by energy companies. So it's a huge representation of financial and utilities. So low emitters and high emitters. And in Japan, you have the largest sector would be industrial, which is nearly 20%. And then in the US, it's more like information technology is nearly 30%. So different composition in different regions. So that's also why you see these regional differences as well, because they have different starting points. But then when you look at within the sectors itself, how these different sectors have done, the biggest improvements that we actually have seen over the last 1.5 decade is within the high emitting sectors, in fact. And that is within the utility sectors. We have seen an improvement. We've also seen improvements within the materials sectors and mining sectors. And these are the front runners when it comes to also in environmental scores, because the way our environmental rating framework works is not just emissions based. In fact, actually, we have kind of positive indicators where companies, for example, are adhering to good biodiversity policies and practices, deforestation practices, water management practices. So companies can actually get benefit from that, and that has come through in this also improvements. We have also seen a decarbonization for sure, and more energy efficient practices. For example, within the utilities sectors, we have seen adaptations of green revenue activities from renewables, for example. Utilities tends to be some of the biggest players together with the larger energy companies, but utilities and materials has been obviously leading the way here as sectors.
Okay, so my next question, Fadi, is one that I'm sure some of our more astute listeners will have anticipated. And that is that in the MSCI World Equity Index today, I believe the allocation to the tech sector is somewhere over 20%, financial is somewhere over 15%. Both of those have risen significantly over the period that we're talking about, the past decade and a half. And it's a familiar argument that those sectors, by their nature, typically have better ESG characteristics than perhaps mining companies, companies that make things physically in the world. To what extent does that change in the composition of the equity benchmark over time? To what extent has that really accounted for the improvement that we've apparently seen? Have you undertaken research to strip out that effect of the change in the benchmark? And if so, what did you find?
That's one of the most important questions we've had actually during this research process. And thank you for asking this excellent questions, because that effectively tells us where did the composition of the benchmark itself create this trend? Is it an effect of the composition, or is it actually an increase or an improvement that we're seeing? And in order to kind of look at it, you can look at it in a different way. We recreated these benchmarks, these global equity benchmarks, by effectively saying that every company in this benchmark is equally important in the way we allocate capital to it. It's just hypothetical. It's called equal weighting type of benchmarks. So Apple will have the same weight as BP, and BP will have the same weight as Shell, and Shell will have the same weight as Microsoft. And that's when you start to see that, okay, if I create a benchmark in this way where everyone is equal, did the level of the E, S, the G, and the T increase? And in fact, it did. There were some differences, slight nuances there. And when it comes to the E, when we know for the global benchmark for the period, went up nearly 50%. When it came to the equal weighting, which is to verify the hypothesis, if there has been a general increase, we found that it's nearly 30%. So it's not exactly 50, but it's still like in the high numbers. And we looked at the social is at par with the benchmark. So actually it is consistent across the S as well, and actually at par with it. And then when it comes to the governance, it was the same, because we haven't seen much changes across the governance. So that's not just specific to the largest companies, but also to the mid-sized companies in the global benchmarks. And interestingly, when you do this type of equal importance or equal weighting, you're effectively giving more weight to the smaller companies in the benchmark. And then when we looked at the transparency, in fact, the transparency then shoots off to over 100% improvement. So actually, the trend is in some cases even stronger than what we have seen on an equal weighting basis across the E, S, and the G, and the T, across the different regions, across the different sectors.
So one more question I had for you, Fadi, was this research is based on an equity index. I wondered how the findings might have differed if you'd looked at a fixed income index. Were the headline findings still applicable, or is it a different story there?
Yeah, so we have looked at fixed income. It's not that we did not look at it. It's the trends are consistent across the fixed income benchmarks as well, so fixed income markets. especially in the euro, dollar, and sterling market. So what we found there is that, okay, so we look at the equity benchmarks, and the equity benchmark are a representation of listed companies globally. But a lot of these listed companies are also the biggest representation in the global fixed income bond benchmarks. Although there are large private companies in the bond benchmarks, but even these companies have followed the trend and followed what we have seen also for the listed companies. So rest assured, the trend remains the same. There are some nuances, of course, because the fixed income benchmark are composed differently than the equity benchmarks. But the companies that are present in the equity benchmark are often also presented in the bond benchmarks, although the sector compositions might be different. But for the new year, we will publish a more focused piece on the trends within the bond benchmarks.
So my final question, Fadi, is what were the key takeaways for you from this research, the messages that you'd want to leave our listeners with?
It's very clear to us that there is an increasing awareness around the world around the environmental and social stories, including some to the extent the governance as well. So awareness, we've seen awareness is very present in the global markets with the investee companies. And we know that the awareness leads to actions, and that the actions has come through by we've seen the level of transparency that is nearly increased by 100% over the 1.5 decade. That's one of the biggest lessons, I would say. The second lessons I would say we've learned from this research is, again, the transparency. Because if you're transparent, you build trust with the investee companies, but also with the investor base. And so that transparency, we work on it from our side in the way the methodology is structured. It's a very simple and transparent methodology. The ratings are published out externally, and we found that it's highly regarded by investee companies and our clients. So that transparency is a very important part, and it plays out nicely. And then we saw that diversity for us is probably one of the biggest winners within the themes that we have in our ESG ratings. And that's an important one because when we're looking at trends, we discuss internally whether we need to change our thresholds of what our policies are. So this data is quite useful in that sense to help us to inform our policies and goals and thresholds that our stewardship are campaigning for. And as we discussed earlier, there are a few lessons here when it comes to the regions. Different regions have different stories, and so they come from different starting points. They have different sector compositions. So the regional differences do matter. And last but not least, if I have to leave the audience with a key message here, it's that this is the beginning of a long journey. And if you look at the global benchmark assets, which is, I don't want to quote an exact number, but it's north of 20 trillion. There is only a few trillions that has been wired into such frameworks globally. And so the journey is long, and these sustainable practices are probably becoming more and more visible and present in the future.
Well, thank you for that great summary, and thanks for taking the time to talk me through your research today. So much food for thought there. If this conversation has whetted your appetite, then please keep an eye out for the white paper, which will be out in the next week or two, and you'll be able to find it by searching for LGIM Insights. Thank you to all our listeners.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. This podcast should not be taken as an invitation to deal in legal and general investments. Any views expressed during this recording belong to the individuals and are based on market conditions at the time of the recording and do not reflect the views of legal and general investment management. Forward-looking statements are by their nature subject to significant risks and uncertainties and are based on internal forecasts and assumptions and should not be relied upon. Where individual stocks are mentioned, these do not constitute a recommendation to buy or sell any security and are for illustrative purposes only. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. For full terms and conditions, please visit our website. To find more content, you can check us out on Twitter, LinkedIn, and our website. Copyright 2023. Legal and General Investment Management Limited. All rights reserved. No part of this publication may be reproduced or transmitted in any form or by any means, including photocopying and recording, without the written permission of the publishers. This material is issued by Legal and General Investment Management Asia Limited, the Licensed Corporation BBB 488, regulated by the Hong Kong Securities and Futures Commission, for professional investors only.